Welcome to the Deep Dive. We're here to get you well informed, fast, and today we're tackling a really interesting question. What actually drove some companies to, well, these huge returns over the last 5 years? I mean, it was a market that twisted and turned like crazy. We've dug into an analysis of 5 top S&P 500 performers. Our mission, go beyond the what's and understand the why. Why did they succeed? And are those reasons still valid today?
Right. And you really need the context here. The benchmark, the S&P 500 itself, it returned, 105.8% total over those 5 years? That's about 15.5% annualized.
Which is pretty impressive on its own, considering.
Exactly, considering we had a global pandemic, massive stimulus, inflation shooting up, rate hikes like crazy, and, oh yeah, the dawn of AI. So it was a whipsaw market, you know? Fast, unpredictable swings. These outperformers, they had to clear a very high bar.
Yeah, 15.5% annualized through that. Wow, it really shows how tough it was just to keep up. So, okay, the 5 companies that blew past this high bar, the analysis points to Alpha Metallurgical Resources get this 3,621% return.
Mind-blowing.
Then Sterling Infrastructure, 2,466%. NVIDIA, 1,569%. Antero Resources, 1,486%. And Tesla, 1,469%. So the big question for you listening is, how on earth did they manage that? And maybe more importantly, can they do it again?
Well, yeah, that's the key. And what the analysis suggests is this clear split, like a bifurcation in why they succeeded. 2 main camps, sort of. On one side, you've got companies riding these powerful, long-term secular growth trends that aren't just, a flash in the pan.
Okay, like who?
Like NVIDIA. Everyone knows them for AI chips, right? But it's more than that. They're dominant across the full stack of AI infrastructure. The real insight, I think, is their software ecosystem, CUD. 6 million developers use it. That creates this huge moat, this lock-in. It's not just hardware.
Ah, so it's sticky. Developers are invested in using their system.
Exactly. And the growth reflects that. Revenue went from like $27 billion in fiscal 23 to projected $130 billion plus in fiscal 25. Just explosive.
Wow.
So yeah, the analysis pegs it as a BY. It's basically the key enabler for the whole AI revolution.
Okay, that makes sense. Who else is in that secular growth camp?
Sterling Infrastructure. They did something smart. They pivoted away from just general contracting towards this high-margin e-infrastructure. So think data centers, especially the ones needed for AI, and also e-commerce facilities. They're building the backbone for the digital world.
Right, the picks and shovels for the digital gold rush.
Kind of, yeah. And they've got consistent growth, a strong backlog, over $1 billion. So the analysis sees Sterling as another BUY, capitalizing on that essential build-out.
Okay, so that's one side. Long-term, sustained growth drivers.
Yeah.
But you mentioned a split, a bifurcation. What's the other side? More volatile.
Precisely. The other group is more about cyclical investments, companies whose fortunes are much more tied to the ups and downs of the economy or specific commodity prices.
Like energy, maybe?
Exactly. Take Antero Resources. It's a low-cost natural gas producer. Its success was really tied to, volatile global gas markets. It benefited hugely when global LNG demand spiked, especially after the Russian invasion of Ukraine pushed prices up.
So, right place, right time.
To a large extent, yes. That's why the analysis calls it a tactical BRY. Good if you're bullish on commodities right now, but maybe not a core long-term thing for everyone.
Got it. And Alpha Metallurgical. That 3,600% return must be cyclical too.
Oh, deeply cyclical. It's all about metallurgical coal, which is used in steelmaking. Its price is incredibly volatile. That huge return shows what can happen when a cycle swings hard in your favor. But it's a double-edged sword. There are big operational risks, extreme price swings, and frankly, massive long-term ESG headwinds, environmental concerns.
Right, coal isn't exactly seen as the future.
Not at all. And look, they actually posted a net loss in the first quarter of 2025 because the market turned. So the analysis is pretty clear here. Avoid. It's just too volatile, too risky long-term, pure market timing almost.
Okay, so we have the secular growers, the cyclicals. But then there's Tesla. It feels like it doesn't quite fit either category neatly. Where does it land?
Yeah, Tesla's definitely the unique case here. It was a growth story, a huge one, scaling the Model 3 and Y, becoming the big EV player. That drove its past performance.
But now, things feel different. More competition. Growth seems slower.
Exactly. It's maturing. Now, the whole valuation, the stock price, it really hinges on these ambitious, high-risk future bets. Things like the robo-taxi network, a cheaper next-gen car. Stuff that might not happen or might take years, and competition is fierce now. Demand is slowing.
So less about current delivery, more about future promises.
Pretty much. That's why the analysis suggests a hold D. It's an innovator, no doubt, but facing real headwinds now. The current price depends a lot on those risky long-term ideas panning out.
Okay, so wrapping this up, it's clear that just looking at past returns isn't enough. These 5 companies had wildly different journeys.
Absolutely. The big takeaway is past performance, even incredible performance like this, doesn't guarantee anything. You have to understand the why. Are those drivers still in place?
Right. The reasons matter. Secular growth, cyclical bets, maybe even venture-style risks like Tesla now. Very different paths.
Totally different paths, different risk profiles. Not all market leaders are built the same, and their futures look very different too.
So, a final thought for you, the listener. Considering these diverse paths, the steady build-out, the commodity roller coaster, the big tech bet, what kind of growth story or maybe what level of risk are you most drawn to understanding better in today's market? Something to chew on. Join us next time for another deep dive.